Hello, everyone, and thanks for joining us for our latest episode in our investor webinar series. As you know, if you've joined our other webinars, I am Chris Lustrino, founder and CEO of KingsCrowd. For 4 years, we've been collecting data on the online private markets and have developed our own rating algorithm out of that, which we have tracked the performance of. And now we're in a position to do something really unique and revolutionary for our industry and for the startup investing markets as a whole. Earlier this year, we launched our first inaugural fund product, which is going to provide data-driven diversification to investors in this market. It's something that's never really been built before, especially for the private markets where data has been so lacking. And we've sat in a position where we think we have an opportunity to truly do something new and unique for investors. So I've asked our Chief Investment Officer, Ahmad Takatkah, to join us today. He is the brains behind this whole thing. He's the brilliant mind that has developed our rating algorithm, has built the investment research team, has invested in making sure the performance of our rating algorithm actually works. And he's truly a brilliant data scientist and venture investor. And I'm so excited to both get to work with him and to get to share him with you here today. So with that, I'm going to kick it off. And Ahmad, thank you so much for joining us.
Thanks for having me.
Absolutely. So I know your story. Obviously, we've been working together for some years now, but would love for you to tell folks who have never met you before a little bit about yourself and what your background is.
Sure, happy to. So I spent almost 8 years as an active VC investor. During those 8 years, I invested in tens of companies across North America, Europe, and the Middle East. And during those 8 years, I also went to Harvard for a training on venture capital and private equity. I was accepted at the Kaufman Fellows Program, which is a 2-year educational program for VC here in the Bay Area in Palo Alto. And I got an MBA. And this is one side of my background. The other side is me being a data scientist. I spent almost 6 years, maybe 7 now, as a data scientist. The idea was I wanted to become more of a data-driven investor. So because I have a technical background, it was easier for me to learn more about data science and practice that. Luckily, I got a job at Carta for 3 years, where I focused on data about investments and cap tables and venture portfolios and venture funds performance. And then I joined KingsCrowd to apply both of these, experiences into one thing, where we created these ratings algorithms.
Well, if you had tried to find the right person for this job, whatever it was, 3-4 years ago now, you could not have done better than finding Ahmad. It is literally like the person that was meant to build this business, which is so cool. And you've been quite successful at it. So let's talk a little bit about the rating algorithm, how it works, what you've built there. And that really is the backbone by which we've now built KingsCrowd Capital. So let's talk about that rating algorithm and how it works.
Yeah, so to start with, we wanted to collect data about all of these online startups. By online startups, we mean the companies that are raising online through whether it's equity crowdfunding or other tools. So we wanted to collect data about the performance of the companies, the track record of the founders and their backgrounds, about the valuation of these companies, the deals, the terms of the deals that they are raising according to. And we ended up collecting more than 500 or identifying 500 actionable data insights or data points about every single company. And as you know, in the online private market, there is more transparency and companies have to share more about their data and their performance. So we had all this wealth of data that nobody has. And we've been collecting this for the past, I think, 3 years or more now. With that, we wanted to use that data to judge the potential of these investment opportunities. And we had multiple ways to start, designing this algorithm. There's the descriptive and there's the predictive analytics or approaches that we can use. We didn't do the predictive because although we have all this wealth of data, it's not enough. We need at least 5, maybe 6 years of data, especially success and failure data for startups to start doing predictive analytics. So we focused on the descriptive one. And in there, to be fair, we said, hey, let's compare all of these investment opportunities together and try to find the best one based on the data we have today. So that's the basic methodology that we went for in creating our ratings algorithm. It's all statistical models. It's not predictive, but descriptive.
Well, it's really interesting because, one model, to your point, could be, let's peg to what success has been in the past. And I think one of the issues or challenges past venture capital firms have run into who have tried to do this data-driven approach is they come out with one data point. Oh, it's all about who backs you. And we all know that that's not true. But what's happening is they're basically getting this warped view of the world where whoever's getting the most funding has A, the highest valuation jumps, and B, sticks around the longest because they tend to have the most amount of money. But it's not actually a true indicator of success. And I think building a fundamental model built on let's look at the true fundamentals of the business and see how they perform over time is going to outlast any of those data-driven approaches going forward. So for me, I get really excited about it because I think we're tearing the model down and building it back up from the ground floor, which is really, really cool. Obviously, this is kind of the next big thing in capital raising, building this diversified fund product. Let's talk a little bit about how we came to the conclusion that we should build KingsCrowd Capital.
Well, the idea came from our own customers. It grew organically because we're seeing 50 to 70 new startups raising online every single week. This became overwhelming to some of our customers. They have the capital, but they don't have the time. So they suggested, hey, why don't you create a fund to utilize your algorithms and then deploy the capital that we can give you, put the capital and then deploy it. And the best companies your algorithms and your team can find. And this is how the idea started. And since we launched the fund, our own customers, our own KingsCrowd members actually invested in the fund more than $2 million.
Yeah, it's unbelievable. Between our hard and soft commitments, we have over $2 million into the fund at this point, which is really, really impressive. Oftentimes, it can take up to a year to raise the first $1 million in a fund. And the fact that we've been able to progress so fast, I think really speaks to the fact that we have a customer base and LP base that's truly come to believe and trust in our rating algorithm and our brand. And they're saying, well, you know what? Why don't you just do all of the work for me, which I think is really cool. Well, there's a reason that they believe us so, right? Which is it goes back to that rating algorithm. It goes back to this data-driven approach we're taking. Let's talk about some of the performance metrics that we've seen from our data thus far.
Of course. I would like to share my screen and just show one chart that we focus on. We've been watching these companies that we have been rating over the years. And as they grow and raise more capital, more subsequent rounds, we look at the valuation growth. And this is for us one measure that we can judge our own algorithm to see if it's working or not. And this is not back testing, it's actual historical data. So we looked at, or we calculated the average unrealized returns. And when I say unrealized, because the company was not sold or there was no exit yet. So it's just valuation growth. So the average valuation growth or unrealized returns in the market overall, the average for highly rated companies from KingsCrowd, the average unrealized returns is higher than the average unrealized return for all companies in the market by about 30%. So there's an upside for following the algorithm. And it's not only that, there's downside protection. Companies that have received high ratings from KingsCrowd actually are less likely to fail in raising the next round. So with that, our algorithm has proven that it's outperforming the market.
So on average, it's had a higher average unrealized return. And by unrealized, we mean if a company has not been sold yet or it hasn't IPO'd yet, there hasn't been a liquidity event. So you can't have realized those gains. But on an unrealized basis, which is most startup investing for 7 to 10 years, what you get is, okay, what was their next round of funding? How much of an upside is that from their current round of funding or their last round of funding? So we've seen, what, is it a 3 or 3.5x on highly rated companies?
3.5x.
3.5x. And then for the broader market, what has it been?
I think it was like 2.5x.
So we've seen about a 2.5 on the overall market, a 3.5 on KingsCrowd's highly rated companies. And then in terms of companies going on and raising second rounds of funding, which is key to making sure they actually see it through and become successful, we've seen a much higher rate of those companies being successful in those second rounds of funding rather than those that were not highly rated by KingsCrowd. So
Correct.
fundamentals wise as well, we're seeing that our companies are setting up for longer term success, which is pretty cool. To your point, Ahmed, is, some of these companies we've seen have had 30, 60, and 70x jumps in valuation. It's just if you look at the overall average, because there's hundreds of companies in each one of those segments, or thousands of companies in each of those segments, that's why you get about a 3.5. But that's kind of the game of startup investing, is you're going to have a few mega winners and you're going to have lots that don't do so well. But we're helping to kind of change that arithmetic, which I think is really, really cool.
Yeah, I can't agree more. We're bringing some certainty level to a space that's very risky and uncertain. So this hopefully will help investors make more informed investment decisions and feel more comfortable in investing in more companies.
And I think one of the other cool things is for there to be more industry upside for our entire industry, right? To see more dollars flow into space. Ultimately, you need institutions to play alongside the retail investor. And how do you get the institutions interested in investing? Well, you start to de-risk the asset class. One of the biggest things that we consistently hear from institutional investors is we can't get into this asset class due to the nature of it being so risky. But if someone could come in and help reduce that risk dramatically, that would completely change the game, and I think really open the doors to push forward this industry. So I'm excited about what we're doing, because I think we're helping to set the entire industry up for success. And I just wanted to get to one point. You were talking about minimizing the risk of failure in those second rounds of funding. How often are companies that go out for a second round of funding successful when they're highly rated by KingsCrowd?
I can talk about the rate of failure because that's what we actually measured. So those who received low ratings from KingsCrowd are about 6% likely to fail in raising the next round. But for those who received high ratings from KingsCrowd, the failure rate is only 2%. So you can see the difference here. Yeah.
That's really good. So only in 2% of cases will companies end up not being able to raise that second round of funding.
Exactly.
It's really, really good. So we're obviously taking a data-driven approach. I think we've been pretty clear about that. And it's pretty clear that when you utilize our data, the performance metrics, again, on a paper basis, we don't know if this will fully play out. We want to be really clear, there's no future considerations being made here. But from what we are seeing in our data, this is what we know. But let's talk a little bit about how our process is actually going to work in terms of making these investment decisions. Is it fully programmatic? Are there humans involved in the fund? How does that work?
Yeah, I love this question. We're trying to automate the whole process, but we're not there yet. I think we can say that the process is kind of 70% automated. The deal sourcing is automated. Evaluation of these companies is automated. Collecting the data is mostly automated. Now, after we screen the universe of all companies that we receive every single week, our team will look at the highly rated companies, conduct more due diligence, talk to the founders, and check if this fits the diversification process or methodology or thesis for our own fund, and then decide to invest.
Got it. And I know that, for a lot of folks who are listening, you're going, well, I can't invest because it's accredited only. And trust me, we want just as much as you to see those rules change and be a part of helping to push those rules to be changed. In the meantime, if you are an investor in KingsCrowd or thinking about becoming an investor in KingsCrowd Inc., the nice thing to know is that we are, KingsCrowd Capital is a wholly owned subsidiary of KingsCrowd Inc. So all of the management fees, all of the carry will ultimately hit the top line of KingsCrowd Inc. So you'll have exposure to the fund products despite not being invested directly into the fund, just so that you kind of know that and how you're actually getting benefit from that as an investor in KingsCrowd Inc. Let's get a little bit into the entire fund. What is kind of the investment thesis? How much money are we trying to raise? How many investments are we planning to make out of the fund? What does that look like?
So let's start with the terms. The fund size, or the target fund size, is $10 million. It's a 10-year term, and we can have up to 250 LPs. The minimum investment is $20,000, and the management fees are much lower than what we see in the market. It's actually only 1% management fees and 10% carry. So those are the terms. Maybe we can talk more about why we cut the fees, the fund fees in half later on. Back to your question on the fund thesis and the portfolio, we're targeting a portfolio of 100 startups. And this goes with the new trend in venture capital, where the more you invest, there's a positive correlation between the number of investments you have and the returns you have, especially if you're investing in the very early stages. And that's what we're doing. So 100 startups portfolio, 30% of that portfolio would be seed companies, and then 40% will be early stage companies. And then we will keep around 30% of the capital as a reserve capital for follow-on investing.
And I'm interested to hear, you said kind of the new approach is actually to invest in more companies rather than, I think the traditional was 10 to 25 companies in a fund. What is the logic there and some of the data that's helped tease that out?
It's basically the data is saying that the more companies there are in your portfolio, it's more likely for you to hit a unicorn or two. So based on research done by multiple companies here, including AngelList, our partner in this fund, they tracked the investments of all angel investors on their platform, and they were able to actually chart that and see and show the correlation, the positive correlation between the number of investments and the returns of the portfolio.
Got it.
Traditionally, as you mentioned, companies would invest in maybe 20 companies, or funds would invest in only 20 companies per fund. And this approach works very well for late stage investments. But the earlier you go, the more you should invest, or the more companies you should have in your portfolio.
No, it makes a lot of sense, because in the early days, there's an incredible amount of risk, but you only need a few to return an entire fund. So the more you have in there, the chances you're going to have a few returners of the fund, rather than if you have 20 and maybe you only end up with one returner of the fund instead of 5, you're increasing your odds of hitting a winner, which I think is really, really interesting. So taking this data-driven approach, as you mentioned, our fees are kind of cut in half of a traditional venture fund, but that is not any sort of sacrifice on quality from our perspective at all. It's actually very intentional. Let's talk about why we're able to lower fees with our model.
Well, we're building venture at scale. We've automated the deal sourcing and the data collection. And this has never been done before in traditional venture capital. First, the data is scarce. And then 2, it's really hard to get or aggregate all of the deals from the universe of companies that you can invest in one place. But KingsCrowd did that for us, and we were able to do that because we're working on the online private market, not the traditional offline private market. So all of the circumstances helped us to create such a fund in such an automated way at scale, and that's why it made sense for us to reduce the fees. Because we're not spending as much as other venture capital firms to deal source and to execute their investments. So we're more capital efficient in this way.
Yeah, that's one of my favorite things about our business is our deal flow is literally automated. All those people say, oh, you have to spend years building up your deal flow in your pipeline. It's like, it's not true. We have access to thousands of deals a year, thousands of deals. Like, we don't know what to do with all of the deals. And then our core product, which we've already monetized, is focused on rating quantitatively every one of those deals with our in-house investment research team. And we get paid to do that. That is our core business. But then we get to remonetize that by taking that data, making investment decisions off of it, and then being able to create a fun product off of that, which we can charge a fee for, but do it at a much more reasonable price because our core business is already doing this. This is a way to kind of double dip and continue to make value out of the ratings that we're developing in-house at KingsCrowd. It truly is venture at scale, adding in this programmatic element of our fund, which I just think is like so unique, so cool, and really innovative in a way that no one has built anything like this for these types of markets before. Obviously, with this data-driven approach, there is a transparency element that I think we should hit on. How are we going to make sure people know what's going into the fund, what's going on with the fund? We have some really cool tools. So let's talk about how they'll be able to track the portfolio.
Sure. Well, if you remember at KingsCrowd, you will see that every user has a portfolio. and they can add the companies they have invested in and track their performance over years, the valuations and any updates you can see about these companies. Now, we're creating a similar portfolio for the fund where LPs in the fund or investors in the fund can access that portfolio. So they will be able to see every single investment we make at the time we make it and receive a notification. Not only that, they will have the opportunity to co-invest with us, because there is no access problem here. If we decide to invest in a company and share that with our LPs, they can go ahead and invest at the same time, on the same deals or terms in those companies.
That's really cool. And I think the last major thing that we should definitely hit on here is, yes, we've built the first fund product, but there's a much grander scheme here of what is possible. With a data-driven approach, we have an opportunity to do some really unique things going forward. Talk about some of our plans for KingsCrowd Capital and how we can continue to build fund products for investors.
Sure. As you mentioned, there are thousands of companies there out there in the market, and it's just a matter of deciding what do you want to invest in. And this first fund, we decided to make it a generalist fund, so we invest across all industries. But we can have themed funds, or let's say founder-focused funds, or an impact fund, or maybe an industry-specific fund like a fintech or biotech or food and beverage fund. This is the plan for the future. So we might have multiple funds. You can either invest in one generalist fund, or you can distribute or create a portfolio of funds as an individual investor in multiple industries that you really care about.
I think this is kind of the grand vision, is this ability to create diversified fund products, kind of what we think of as one-click diversification into any theme, concept, thought that you might have. And one of the things that we haven't even hit on here yet is that we're expanding into multiple asset classes and geographies as well, right? We're going into real estate, we're going into collectibles, eventually digital securities of some sort. So if you think about it, right, there will be a day where we could spin up a baseball card fund. There will be a day when we could spin up, a French wine fund. There will be a day when we could have a commercial real estate fund that utilizes all of these platforms and all of the deal flow from all of these different marketplaces and provide that one-click diversification into any one of these assets. I mean, it really is a powerful way to add a bunch of alts into your portfolio while providing a de-risk methodology to do so, and a really easy way to do so that doesn't require a whole lot of work or time on your part, which I think is a big value add for a lot of investors. So Ahmed, you've worked at a traditional venture fund. Now you're working with us. You've been in data science positions. What do you think is one of the kind of most powerful or unique differentiators of what it is that we're doing here at KingsCrowd Capital?
In traditional funds, first of all, you can't access enough data, and you don't have the resources to create a big data team unless you're a very big fund. And the majority of the funds out there are not. So KingsCrowd is doing all of that for the fund, or it's already the core business model for KingsCrowd is to aggregate all of the companies and from everywhere. We're talking now about the US, but as you mentioned, we might expand in the near future to Europe and some other continents. So aggregating everything in one place, collecting 500 data points on every single company. And this data is not the traditional data that you find in Crunchbase or PitchBook or other data sources. It's tailored to this specific industry. We created the data model for this, and we collected all of these data for all of these companies. So first, of course, the aggregation, the data, and then of course the algorithms that we use to evaluate these companies, and then the tools that KingsCrowd created for anyone who would invest in the fund to access the fund portfolio, the co-invest with the fund automatically, or select companies to co-invest with the fund. And all of these tools that KingsCrowd is creating or has created make a huge difference between KingsCrowd Capital and any traditional fund. And I like to say this, KingsCrowd started as a data company, but then maybe now it's evolving to become not a venture fund in the traditional way. It's creating fund products, financial products for our customers, for KingsCrowd customers. And sky's the limit for this.
Couldn't agree more. I think we have a really, really exciting future ahead of us. Obviously, with the investments being made in this Series A, the thinking here is that we continue to invest in building out new asset class data sets. We continue to enhance and invest in building out our current data sets and tracking more and more companies as this market grows, and then be able to look into those other geographies. And with all of that, begin to invest into developing other fund products and working to lower minimums for investors, working to create more fund products for investors, looking for ways to bring more investors into our universe who want to utilize our products, and really kind of continue to grow this thing and scale it up. So there is
I can add.
Please,
I can add more. So an idea that we discussed earlier, that maybe we can help or enable VCs or investors to create their own funds on our platform. We're not keeping anything secret. The market is transparent, and we are as transparent as the market. So the ratings are out there. Anyone can create a fund and maybe join us and or list that fund on our own platform so that we can promote their funds to our own customers. In addition, we're not keeping anything secret. We have a market analytics page on KingsCrowd where you can see everything about this market from the year this market kind of matured. I think we have data since 2018. And you can see the valuation trends, the number of companies, active companies that are raising every month. You can see where the money is actually invested, how much money is invested every single month in all of these companies. And we're talking about all of the crowdfunding type companies, RegCF, Reg A Plus, and soon we'll add Reg D. So you have all of that universe handed to you, and you can do whatever you want with that.
Thank you so much, everyone, for joining us today for another webinar where we are discussing and learning more about all of the things we're investing in here at KingsCrowd, thanks to investors like you who have backed us with over $5 million to date to build out a world-class product and create a company that can truly revolutionize the way people invest into the future. If you'd like to join us, you can invest at invest.kingscrowd.com and become a part of our journey. As we succeed, you succeed. We're really looking forward to the future and would love to have you be a part of it. Thank you so much and have a wonderful day.